A key component of the modern world economy, the chemical industry delivers products and innovations to enhance everyday life. It is also an industry in transformation, where chemical executives and workers are delivering growth and industry-changing advancements while responding to pressures from investors, regulators, and public opinion. Discover how leading companies are approaching these challenges here on The Chemical Show. Join Victoria Meyer, president of Progressio Global and host of The Chemical Show, as she speaks with executives across the industry and learns how they are leading their companies to grow, transform, and push industry boundaries on all frontiers. Here's your host, Victoria Meyer.
Hi, this is Victoria Meyer. Welcome back to The Chemical Show. Today, I am speaking with John Richardson, who is the senior consultant with ICIS, focusing primarily on the petrochemical market and polyolefins market in Asia and Middle East. And he brings that perspective as well as a global perspective. Interesting fact, John's been on the podcast several times, and his most recent episode 102, which is titled China's Aging Demographics and the Future of the Chemical Industry, was, according to Spotify, our most shared episode in 2023. So we're going to see if this episode could become the most shared episode in 2024. We'll find out. John, welcome to The Chemical Show.
Thank you, Victoria. Thank you very much.
So let's just talk a bit about a reflection on 2023. So we spoke a couple times. We spoke at the beginning of the year. We spoke mid-year, just talking about some of the challenges going on. From where you sit, what was going on in 2023 now that we're at the end of it and can look backwards?
I think, Victoria, it really probably all started in late 2021. It's built up, the momentum's built up this year, which was the Evergrande moment when you suddenly realize the Chinese property bubble had burst, which is like 29% of GDP. And then you got this drip effect of the worsening demographics in China. So I think the big shock for people in 2023 was there was no big zero COVID, post-zero COVID. I didn't think there would be, to be honest, because I felt that the effect of that real estate loss of momentum and the youth unemployment and the geopolitics, we shouldn't forget that, the increased geopolitical tension to the West, all of those would keep consumer confidence very dampened in China. And we've seen that. So that's been a shock for people. And then the consequence of what we talked about before was that back in when all these projects were being planned, all these crackers and polyolefin plants were being planned, people thought that China would grow at 6 to 8% a year in terms of polyolefins demand, whereas now we're seeing 1 to 3%. And when I saw the data originally about how much China dominates global demand, I thought our data was wrong, to be quite frank. But I checked it out and it's right. And China completely dominates global demand. So you build a project anywhere to serve any market, and obviously an export-focused project in particular, and it's affected by that effective demand growth gap between earlier expectations, what's happening. So that explains why we've got the lowest operating rates on record across the polyolefin business globally.
Well, and there's no doubt that we overbuilt. I think we probably even overbuilt, even if you assumed a 6% growth rate in China. Would you say?
Yeah. Actually, look at polypropylene, surprisingly no, because I modeled it. So I assumed that we would see 6 to 8% growth. 8%. I pushed it with 8%. And by 2028, we had global reinvestment conditions for polypropylene, assuming 8% growth. 6%, of course.
Do you think that's still true?
Absolutely not. We're now going to see 1 to 3% polypropylene growth. Same with polyethylene. We might even see some minus years of growth going forward, possibly. And we're seeing an extended trough of very low operating rates. And we're at the point now where the less competitive, the problem that we face is the really less competitive producers in South Korea, Singapore, even Thailand, perhaps, Taiwan and Japan, and Europe, having to look really hard at their assets. Obviously, those directly exposed to China, I could talk about Europe in a minute, but those exposed to China directly, the South Koreans and Singapore, etc., have a huge problem because of rising Chinese self-sufficiency as well. China keeps building out this capacity and the net imports are going down. and the demand growth is weak. And it's really, for the South Koreans, it really is a play almost entirely on Chinese market. So what do they do next?
Yeah. Let's just talk about what we're looking at going into 24 and beyond. So you see a protracted trough. Is that what you're saying? And how long and how protracted? That's the billion-dollar question. Yeah.
I hate to be Jeremiah, especially near Christmas, but the problem is that from 2026 onwards, they've got even more capacity, right? Which counts
particularly.
Well, China and the Middle East and the US. So you think, what's going on here? And it's really, I mean, Aramco, Saudi Arabia faces this challenge of declining crude oil demand, right? Electrification. I believe the IEA figures, we're going to see a steep decline in crude oil demand in the next 10, 15 years. Obviously, the number one asset for Saudi Arabia is crude oil, national asset. Saudi Aramco are turning more of the oil into chemicals, crude oil to chemical. Crude oil to chemicals is a group of new technologies different from the earlier work on increasing chemical feedstock from refineries. This is a step change. So the crude oil to chemicals could go from, say, 30% of refinery output to chemical feedstock to 45%. And the ultimate aim by Aramco is to get to 70 to 80%. They're not there yet. But they're investing in these giant crude oil to chemical projects in the Middle East and in China because they want to make sure they consume the oil. And these are huge.
So is this about economies of scale, or is it more about cheap feedstock consumption?
Both. I think it's the alternative value of leaving the crude in the ground for good. What does that mean? Obviously, the alternative value is zero if you can't exploit it. Building these giant chemical plants that are super efficient, making also lots of base oils and low sulfur diesel and other fuels as well. So you still get quite high output of fuels. So these giant complexes, and also lower carbon, which is what they say because of carbon capture and storage. So they're saying that in a world where we're seeing a higher price on carbon, particularly in Europe's going to thinking of introducing a carbon border adjustment mechanism applying to organic chemicals and polymers by 2030. So that's in effect, you're going to pay a higher import tariff if you have a high carbon output, your scope 1 and 2 emissions. So if Aramco can demonstrate that they're lower carbon, they can export to Europe very competitively.
Yeah. So effectively what's happening is, if I can maybe reframe it a little bit, if we maybe dial the circle around Europe and the relationship between Middle East and Europe and China and Europe, is Europe has set some very high environmental standards. So they're making it less cost effective to produce there. Saudi Arabia and China are coming in with crude to chemicals that basically they're using a zero feedstock cost.
In effect.
And then they're getting tax benefits to import into China on the premise of being a more carbon efficient manufacturing. Is that right?
It certainly applies to Europe eventually.
Okay.
If the CBAM comes in, which we don't know if it will, but the EU might bring it in before 2030. Clearly, that's the objective for Europe. Don't think that applies to China yet, but actually, sorry, you're right. In terms of domestic expansion, they want to be lower carbon, right? So they're looking at the BSF project, which is a different group of chemicals we're not covering. It will be run entirely on renewable energy, right? It's all the oxo alcohols that I don't cover, but that's certainly an objective within China. So yes, that's right, within China. So that Aramco and BSF and Shell, etc., can help with the lower carbon agenda in China.
Yeah.
I think the other side to this as well, which is quite shocking from an industry perspective, is that the standard view is China will still be a major importer of paraxylene, MEG, polyethylene, polypropylene by 2030. But the argument is that the theory out there, and of course we don't know if it's true, is under the 15th five-year plan, which is 2026 to 2030, they want to get to pretty much balanced positions in all these products by 2030.
China does.
Yeah, if that were to happen, then what does South Korea do? What does Singapore do? They've lost their main export market. And of course, it won't happen immediately. So you start doing the math about what it would mean. And I did it for HTP for South Korea. Assuming that they lost all their exports to China and also to Europe, assuming that they can't compete in terms of cost of carbon and scale, the effective HTP operating rate in Korea goes down to 23% by 2030. Now,
Which is
obviously, that can't,
inoperable
of
at that
course.
point.
Obviously, you talk about shutdowns, aren't you? You talk about shutdowns long before we get to that point. So that's how serious it is, because you can assume that if they build out this capacity, this COTC capacity, they will get into Europe at very competitive prices. That squeezes, as I said, the South Koreans out of Europe. You can assume that Southeast Asia, as the second biggest net import market in the world, or third, I think, behind Europe and China, becomes a real battleground, right? So then South Korea struggles in Southeast Asia against all this Middle East stuff, right? Now, this is an extreme scenario, Victoria. I'm saying it goes from where it is this year to zero by 2030. Their exports.
Yeah, that's pretty fast.
Yeah, that's probably it's an exaggerated scenario, but it's explaining the pressures that could take longer than that. But this is South Korea's got to reinvent itself and think what it does next.
So, what are the trends that you are monitoring? So, I know you've talked a lot about a declining Chinese demand, right? So we've gone from an environment where there was 6 to 8% annual growth to, so it's maybe not declining demand, but it's declining growth, right? So going from 6 to 8% growth down to 1 to 3% growth per annum. So what is it that you're watching? What trends are you watching? What trends should we be watching as we wonder about whether is China going to recover its growth? Is it not going to recover its growth? How is this going to play out? What are the tea leaves and the trends that you're feeding into your assumptions and your point of view?
I think in terms of China's economy, I think there's a great piece by a guy called Michael Pettis that put on the blog the other day, and rock and a hard place, right? Because the investment-led growth model, I mean, what's happened is since the collapse of real estate, China's put more money into manufacturing capacity, including chemicals, of course. And in order for them to carry on with the investment-led growth, the rest of the world has to cut back on investment in manufacturing by 1 percentage point. Now, is that going to happen in the EU and the US and India? No, because of the Inflation Reduction Act, maybe politics.
Maybe in EU, honestly, from where I sit, it feels like the EU doesn't want to invest in itself anymore. That's certainly what the policies are driving.
Could make room, but then China starts exporting deflation in effect. If they cannot go the investment-led route, right, which is deflationary, would also increase the debt ratio to GDP to perhaps an unsustainable level. That's another argument. They've got to try and raise domestic consumption by 6 to 7% per year.
Yeah.
But no country in the history of the world in this stage of economic development has managed that kind of consumption growth. Before the pandemic, it was growing at 4%. You've got an aging population. You've got issues with government financing to pay for it. You've got the fact that if you transferred wealth from businesses to homes, you undermine export competitiveness because you'll be raising wages, right? So I think it's a rock and a hard place. So I think you've got to accept China will grow, but a lower growth rate than we see.
How can China continue to afford investment? Given, as you say, the financial woes were tied to real estate, the declining population. I've seen some interesting things. If you recall, earlier this year, we talked a lot, not just you and I, but just the media was talking a lot about unemployment for youth or young adult unemployment, right? College grads couldn't find jobs. And now it's gone silent, which is also notable. And yet I know that there's this long-term strategy to get to a net zero, right? So a balanced import perspective or self-sufficiency. Where's the money coming from? How are they affording this? And is it realistic?
Yeah, and that's if they want to hit 4 to 5% growth, and Xi Jinping says need 4.7% growth by every year to 2035 to double the size of the economy. The government could just keep creating more debt, right? Building more manufacturing capacity. What's the return on that debt? Right now, it's a closed account. It's not. You say China hasn't got a fully convertible currency, so you won't get something like the global financial crisis. Apparently, it's a closed economy. So in theory, you could just keep creating more debt, get the policy banks to lend more money, but of course, the return on investment is getting weaker and weaker. And then your problem is you're exporting into a world that says we don't want these exports, right? So you get more trade protectionism pushing back potentially, or you get deflation as you flood the world with stuff. So yeah, it's very difficult, right? And the other route, as I said, is to grow consumption in a world where you have high youth unemployment, lack of confidence in the economy, aging population, people saving more for pension and healthcare, when you have very poor pension and healthcare coverage. So I think they're stuck, really. To your point, though, it could be they don't reach petrochemical self-sufficiency because it just doesn't make sense, right?
Mm.
So we don't see this big build out. We see a slowdown and therefore there's more imports. There's still a strong import market by 2030,
Right.
which is certainly a scenario to consider.
We'll be right back. At Ecovist, they're accelerating the transition to a sustainability-driven future. Their long history of innovation, expertise, and customer collaboration supports the development of proprietary catalysts and services across their two industry-leading businesses, Advanced Materials and Catalysts and Eco Services. Advanced Materials and Catalysts is a leader in proprietary and customized technologies for polymers, cleaner fuels, emissions control, and circularity. Eco Services is the largest North American recycler of spent sulfuric acid. Ecovist, your catalyst for positive change.
I think more broadly, looking globally, I think we should talk about the ethane crackers as well, right? So we talked about CO2 a lot, but there's a lot of ethane crackers being built in Qatar, in Abu Dhabi, in the US, and in Canada, right? And that's a lot of capacity, again, by the oil and gas majors, isn't it? And I think there's a scenario where we end up with a petrochemical industry dominated by the super majors, right? I call them the super majors, oil and gas companies. Fewer companies dominate. And then what happens to the older assets, the smaller assets, the ones exposed to China, etc.? Well, do they stumble on at very low operating rates for many years, or do they shut down en masse? Now, shutting down is really hard, isn't it? You've got environmental cleanup, pensions. Yeah.
And then there's, depending on how you run these economic scenarios, at times you say it's just, if they're, let's just say, paid for and depreciated, it's just cheaper to run them at cost.
Yeah. And you might be looking at rolling,
which is one of the things I feel like we've not seen a lot of shutdowns because these assets are fully depreciated. They may not be truly economical, but when it's cheap to operate and the costs that you have to cover are low, you just keep running.
Exactly. You're exactly right. We've never seen this big wave of shutdowns. And also, now it's to keep the upstream refinery going as well. Where else you sell naphtha in a inland refinery chemical plant in Europe? Where else do you sell your naphtha? So therefore, you can't operate your refinery, and then you've lost your local fuels self-sufficiency. And in Korea, you have the chaebol that back these companies are part of huge industrial conglomerates. And so it's not straightforward. So I think, but probably a more likely scenario is they stumble on under the super majors outcome. But I think there's another scenario of deglobalization. These are two extremes,
right?
And we could be ending.
Yeah, the extreme is globalization, full globalization. Yeah.
And the other one is we end up with the EU saying, hold on, every one job upstream equals around 10, a maximum of 10 downstream, right? So we close.
Do they recognize this?
I think they should.
I know they should.
Yeah, and they say we need to adjust the whole carbon mechanism, the trading system. We need to support local chemical industry in decarbonisation. We need to recognise that we need to keep our local industries because of the employment reason. And there's another factor, this Victoria, recycling, right? We know that's a niche business, but it's an important business, right?
Hugely important.
And the problem is the collapse of virgin prices has made recycling very difficult. Give me an example in Australia, that the MRFs, the guys who sort the plastic waste, process it to hand it out to the recyclers, they were getting paid around 150 barrels a bale, I think, last year, right? Now they're having to pay the recyclers $30 a barrel to take the bales away because of the collapse of the virgin prices. Now, the MRFs are still operating because they get a lot of money from the deposit return schemes for bottles, so they still make money, right? But for the plastic bales, they're losing money.
It's a conundrum, John. So I've talked to a number of people across the value chain on this. Consumer products companies, for instance, have all set these targets about the amount, the quantities of recycled material or recyclable material, which is an interesting thing when you just lump it
It's a
together.
big difference.
But if you're targeting a recycled content, they have targets, but they're not willing necessarily to pay for them. There's not enough recycled feedstock to support that. And as I shared with you earlier, I think we can have these municipal recycling systems, the MRFs, as you talk about it, but it's still human behavior that requires to make the effort to recycle.
You made a very good point, which I
You know,
hadn't thought about.
I certainly
I
know
mean,
many people that don't recycle,
yeah.
even though it's easy. We have in my communities, other communities around Houston, most of us have curbside recycling. All you have to do is throw it in a different bin, and people don't do it.
And there's no, as you say, if the targets are being missed, if recyclers are shutting down, if it's not economic, then where's the confidence in the public? And without the public support, it's not going to work. That's a very good point.
And with this plastics treaty, which is obviously still under negotiations, got the plastics treaty under negotiation. We're just at the tail end of COP 28 or COP 28, whatever you want to call it, which I think has maybe not produced the results people had hoped. There seems to be, but certainly with the plastics treaty, there's a desire to put the burden of reuse and recycling on the resin producer, which is a bit of a conundrum because they're not the ones that can influence. They have an influence on recycling, making sure that something is able to be recycled, but the physical act of recycling is on a consumer basis.
Very good point. And also the brand owners as well, because
and the brand owners. Yeah.
If you're a brand owner, you've got good margins already. You're not going to pay more for recycled material. You're having to pay more at the moment, but that's the pressure. And you got the virgin price that's going to be cheap for a long time. So it's a disincentive, isn't it?
Right.
So you got to get the policy levers right to incentivize everybody up and down the value chain, including, of course, as you say, which I hadn't thought about, the actual people doing the initial recycling, the public. And I think if you want a thriving recycle business in Europe and in Australia and elsewhere in the developed world, we're talking, you've got to think about how we change the policy levers to protect the industry from a flood of virgin polymer. And then, of course, you go back to Europe, which has got a big Australia's got a very small virgin industry, but that's still important. In Australia, we've got a virgin industry here, which will be under a lot of threat. But Europe's got a huge virgin industry. We need to support that virgin industry as well. So I think deglobalization, if the policymakers wake up, is a pretty likely outcome. To think.
Well, and to be fair, the other thing that deglobalization does is, I guess, and theoretically at least, it reduces type 3 emissions, which is where a lot of the targets are because of the emissions, the cost of transportation. So you're transporting things long distance. There's a lot of emissions tied to logistics.
How do you know as well? In life cycle analysis, if it's a chemical plant in the US and Middle East, taking oil and gas out of the ground, fugitive methane emissions, as they say, how do you know from the gas well to the polyethylene pellet delivered into a converter what is the true emissions versus a local supply chain that perhaps you can monitor better?
Yeah. I don't know. That's the billion-dollar question. I think people are waiting still as well for common standards to help define that measurement.
Yes, I think common.
So we're in a period of flux and transformation. There's no doubt about it, John.
It's a new landscape. I think we're not returning to business as usual. As I said, I'm leaning a bit more towards deglobalization, but come back in a month, I may have changed my mind. But it depends on the politicians. Yeah.
Does deglobalization go along with smaller asset sizes? So if you look at the trend that we've been on for the past 20 plus years, the size of the crackers, the size of the polyolefins units, the size of everything has just gotten massive. And a lot of it's this view of economies of scale, a part of it's ego, right? And bragging rights. Does deglobalization imply a shift to smaller units?
Very good question. I think it would imply that some of the mega units I've been talking about won't get built. So some of the absolutely giant COTC plants may not be as viable.
Right.
Although, of course, it's using oil, is it will be left in the ground, so it may still happen anyway. projects might get delayed, ethane and oil-based projects. I think it could give more life to smaller, older units, right? So yes, I think the answer is yes, because basically you have project cancellations and delays for the ever bigger unit, right?
Right, which are fundamentally dependent on exports and going to the biggest markets. Yeah.
So sort of when I started this, I think back in 1998, a world scale cracker was what, 700,000, 800,000 tons, something like that.
Probably, yeah.
Probably, I can't remember. But now it's, what is it, 1.5, 1.6?
Yeah,
so maybe we stop there. That's the ceiling. We don't go any higher. And you get all these smaller local assets that thrive, and gradually over time, you get recycling getting more. But that's going to take a long time, isn't it? Really?
Yeah.
So I think that's
makes me wonder if there's lessons that we can learn from other industries. I don't know. What pops into my head at the moment is, for instance, the steel industry that went from mega units down to smaller, more nimble units. Is there a model there that we should be looking at? Is there a model in refining where we actually have quite a blend of mega sized refineries as well as smaller focused refineries? And I think some of the investment tends to be in smaller refineries these days versus oversized ones.
The carbon issue, if you've got sustainable aviation fuel eventually, people talk about that, you've got electrification of transport, but you've still got need for some refinery products, maybe biorefineries, cooking oil to make into SAF on a scale, you hydrogenate it and everything. We've been talking about it in Australia. Maybe that creates more viability for those smaller older refineries around the carbon story. You don't have to have a mega Middle East refinery, because I know in Australia we've got 2 refineries left, and the one in Victoria has got great plans around SAF and sustainability. Does that give it a niche?
Maybe.
And it's got a polypropylene plant downstream. Yeah.
So, John, we talk about just this whole landscape and how it's shifting, and there's a lot of uncertainty, although the way it's playing out, it seems directionally it's moving to, I don't know, longer term trough, certainly in polyolefins, this shift to crude to chemicals, demographic challenges, et cetera. You talk to a lot of different companies, different leaders. What are the most effective companies or leading companies? So the leaders in the leading companies, what are they doing to respond to and to thrive in this business environment? What are you seeing from the leaders?
If you can't beat them, join them. So you have people basically saying China is going to get to self-sufficient. So you got BASF, you've got Shell and Exxon investing heavily in China, and of course Aramco. So if that's your play, and you think that's the right thing to do, and it's very sensitive around Europe, obviously, what happens next in Europe with the high energy costs, that kind of makes sense, right? From the giant oil and gas majors, we've got Aramco converting oil into chemicals, but I do wonder about the others. I don't know, I'm just purely speculating now. Is that the right policy? Because then you can change more oil into chemicals. That would make sense. I really think it depends on who I'm going to hedge this one, because basically the strategy depends on where you see the world ending between deglobalization and super majors, and the winners will be the ones who get that right. So will it be the small local companies who turn to biorefineries and recycling and recognize that the EU is going to be more of a protected market and they survive and thrive? Or is it the giant companies that relocate to China or end up dominating global export flows? I'm not giving you an answer here, but I think that
no, really depends. So you're going to tell us to all just stay tuned.
I think that's it. I'm not. Probably maybe a mixture of both. That in certain regions, the niche local company does really well with the right regulatory framework. But if you're only a big international player, there'll be enough international room for you to be a mega exporter of really cheap petrochemicals, and also support China's self-sufficiency. So there's 3 strands there, isn't there?
Yeah, there sure is. Well, I think we're in for another roller coaster.
Certainly are. Yeah,
and a ride for 2024 and into 2025.
I think no recovery in 2024, I'm afraid. I hope I'm wrong.
You don't think? Some people are predicting recovery by end of the year. You don't see that?
Hard to see. Yeah.
Okay. What has to change for us to see a recovery in 2024?
Again, Victoria, we talk about closing assets down, which is really hard. You end up running your assets really low for a long time, which seems quite likely. Because China ain't going to suddenly pull all this demand in. It can't. So what changes? Yes, I think the rest of the world's okay in terms of, hopefully we got on top of inflation. The US will be all right, I think. US is recession proof. It's amazing. EU should be all right. But it's the fact that China dominates global demand. This is the problem, right? What's the upside for China? And because of the overcapacity, either you shut it down or you run it low. And to shut it down,
they're going to run it low.
To get to the higher rates. Yeah, to get to higher operating rates requires major shutdowns, and I don't think we're going to see them.
Yeah. All right.
If we weren't so unbalanced, and if Europe and US and the rest of the developing world consume more of demand, it's the fact that China dominates global demand. That's the problem.
Right. We've come to rely on China. The world has come to rely on China.
Exactly.
To buy resin and produce all kinds of plastic stuff.
India's a fantastic story. India's been, but it's tiny compared with China. That's the problem. The rest of the developing world is small compared to China. So that can't really lift operating rates without major plant closures. And we're not going to see that.
So I actually think that we're going to start... We're starting to see it. Will we see it in polyolefins? Will we see it in all the places we need to? There's certainly been some rationalization in 2023, right? Across various companies. And my projection is that we're going to see more.
That could mean by the end of the year, we see an uptick in operating rates. That was a scenario, I think. Yeah.
Okay.
So watch that closely.
We'll see. Stay tuned. All right, John. As always, this was good, and it's always an interesting conversation. I know that you shared a deck with me. I'm hoping I'm going to be able to post this and share this with folks.
Yes. Yeah. That's
awesome. So that'll be available on the show notes and on the website and elsewhere if people want it. Thank you for joining us today on The Chemical Show, John. Appreciate it.
Enjoyed it. Thank you very much. Thank you.
Likewise. And thank you, everyone, for listening. Keep listening, keep following, keep sharing, and we will talk again soon.
We've come to the end of today's podcast. We hope you enjoyed your time with us and want to learn more. Simply visit thechemicalshow.com for additional information and helpful resources. Join us again next time here on The Chemical Show with Victoria Meyer.